Okay, good morning, everybody. Good morning, good day if you're somewhere where it's sunny and warm in the afternoon. My name is Robert Whitaker. I'm going to be hosting today's Merkle Meets. Today we have a really good panel, The Road to Clarity. This mostly deals with U.S., so if you're not from the U.S., you're kind of out. I think it's probably good information to have. But we're going to deal with SEC and CFTC oversight in the digital economy. Today I have David Hirsch with us. I'm going to let David do his own intro in just a second. And we have Rob Swartz. Rob is actually having just a bit of technical problems um, logging on this morning, but he will be here shortly. I'm convinced of that. So, anyway, welcome to our meeting and let's get into it. Dave, you want to introduce yourself?
Sure, absolutely. Good morning, everybody. Good afternoon if you're someplace a little bit later in the day. Hope you're all having a good start to the week. Uh, as Robert indicated, I'm Dave Hirsch. I'm a partner at the law firm McGuire Woods. I'm based in their DC office. Been there over a year, but before that, I spent almost 9 years at the United States Securities and Exchange Commission, where my last role there was chief of the crypto assets and cyber unit in a division of enforcement. So spent a lot of time thinking about and pursuing actions relating to alleged violations of the securities laws as they apply to crypto assets and digital assets. Before that, I had 2 years as counsel to Commissioner Crenshaw, also at the SEC, where I was her enforcement counsel, but also led crypto and cyber policy and outreach, and started at the commission in the Fort Worth regional office doing crypto from day one. So I've been in crypto regulatory space since 2015. Really excited to talk about all the things we've seen changing over the last year or so and where things may be going from here.
Excellent, excellent, Dave. It looks like you and I have been in crypto about the same amount of time. I started in 2014 there at HSI, so both been in the. I've been in more in the enforcement space than the regulatory space, but crypto has definitely changed in the several years. What a little over a decade since you and I first got into it. Certainly, when it first started, it was Bitcoin, and although we thought it was rocket science, it was not. And now things move at warp speed every day. So every day is like a year in some other space. It's really moving quickly. So today we're going to talk about a few things. First, let me read kind of off the topic today. So, kind of a summary of what we're going to talk about today is Project Crypto, which is now underway. The SEC and CFTC are signaling a new phase of market structure and oversight for digital assets. That's very true. Together with the pending Clarity Act, we have the Genius Act already. Clarity Act is on the table. We don't know what's going to happen with it, but it's on the table. These initiatives aim to draw sharper boundaries between securities and commodities. And I think that's one thing we got to define here in just a second is security and commodities. What are they and why are they different? Formalize dual reporting obligations and expand supervisory reach over exchanges, custodians, and wallet providers. Now, people may not think those are three big deals, but those are three big deals: exchanges, custodians, and wallet providers. They're all different. They all do a little bit different stuff, but they all may be regulated separately, which could cause issues or not, right? So we'll examine how regulatory priorities are shifting, what continuity firms can expect from the existing frameworks, and where new obligations may shape compliance strategy. And that's a big one, right? So how are companies going to comply with what's coming down the road? So I think I'll leave it there, and then we'll just jump into it. Dave, you want to take a shot at Project Crypto and the Clarity Act, and kind of the difference between CFTC and SEC, and give us your thoughts on what I just said.
Sure, sure. There's a lot there to unpack. So,
Absolutely.
starting at the beginning, I think it's fair to say we have, at least in the years I've been an attorney and been focused on the regulatory space, I have never seen as rapid or dramatic a shift in regulatory approach as what we have witnessed happening with crypto between the Gary Gensler SEC administration and the Paul Atkins SEC administration. Could not be more night and day. Under the Gensler administration, which I worked under, there were enforcement actions brought against almost all of the leading intermediaries, so exchanges, brokers, dealers, market makers, investigations into a wide swath of crypto conduct, whether that was issuers or intermediary behavior, and cases brought both for registration violations and for misrepresentations or failure to disclose material information. the registration cases were important from the last administration's perspective because it sets minimum standards of compliance and information disclosure for entities that were in the crypto space who the SEC believed were offering and selling securities based on long definitions from the middle of the last century and before. And so kind of transitioning to your next question, Robert, about the difference between securities and commodities, the Commodity Exchange Act is written very broadly and encompasses a wide variety of different types of investments. Commodities traditionally have been thought of as um, kind of agricultural products and metals and other inputs into construction, farming, produce, other things like that. And so think about orange juice futures and gold and pork bellies and iron ore and things like that. So, and a lot of those assets are standardizable. So you are worrying about how much is going to be delivered on a certain day in the future, not on the quality of the product that will be delivered. It's a commodity, meaning one bushel of corn should be very much like another bushel of corn for the purposes of those types of investments. There's an exception for, hey, here's Rob. Welcome, Rob.
Hey, I made it.
Apologies for your technical difficulties. I'm sure that must have been stressful and frustrating.
Yeah, but I blame the machine, so not the human beings. It's I mean, look, you put in the email address, you hit send, you expect it to work. So I apologize if it's Morgan Lewis's fault.
It's okay. We're happy to have you, Rob. Thank you very much. For everyone watching, Rob Schwartz is joining us. David, can we take just a break for 30 seconds? Let Rob introduce himself. Great. Rob, can you give us a little intro on where you're at, who you are, and what brings you to this meeting this morning?
Well, what brings me to this meeting this morning is my cell phone, which I certainly did not intend, but here I am at least. Rob Schwartz, I am a partner in the futures and derivatives practice at the Morgan Lewis law firm. Before that, I spent 13 years at the CFTC, including as its general counsel for the Final Four. And dealt a lot with crypto, dealt a lot with versions of legislation over the years, giving technical assistance to the Hill, and certainly paying attention to it a lot. And here I am.
Okay, well, it's great to have you on the call this morning. We were just talking about kind of the intro, what the new changing environment looks like. Dave was going over kind of what the difference between commodities and securities are. I think commodities is more down your road, but I'm gonna let Dave continue, and then the next question is coming just to you. So, you checked out for a while. You didn't get the opening, so you get the next question whether you're ready or not.
All right, ready or not? Go ahead.
All right, here you go. Dave, please continue, sir.
So I will be happy to defer to Rob, who is much more expert on the Commodities and Exchange Act than I am, but I had been explaining that it is broadly written, covers a lot of different types of investments, but has a carve out for securities. And so one of the questions then is, what defines a security? How do you know which you're dealing with and therefore which regulator you're accountable to? And the SEC has in its enabling statutes, the 33 Act, the Securities Act, and the 34 Act, the Securities and Exchange Act, definitions of securities. And those definitions are really just a list of other types of things that all meet the definition of security. So think about stocks and bonds and notes and other types of financial instruments you may be familiar with. And then it has investment contract, which is not defined in those statutes. And so eventually, years later, in 1946, the US Supreme Court effectively defined what an investment contract is for purposes of securities and exchange jurisdiction. And that is an investment of money in a common enterprise with an expectation of profits based on the efforts of a third party. The definition has been tailored by later court decisions over the years, but has never really been retouched by legislation. And so this is court-based law to a large extent rather than congressionally based law or even rulemaking done by the SEC or another type of independent financial oversight agency. But it's a very fact-specific analysis. Like, are those expectations sufficient to create an investment contract? Are they reasonable? Is it a common enterprise? The SEC would have to look at each one of those issues individually for each offering to try and determine if it is or is not a security. If it is a security, there may be registration requirements go along with it. There are obligations to make honest and disclosures about material facts about those investments. If it's not a security, you may still have those obligations, but it's not the SEC who you're accountable to. It might be the CFTC, it might be the FTC, or another agency. And so a lot of what is now happening in Congress and elsewhere is an effort to try and better define which bucket a particular asset falls within, which regulator is overseeing conduct relating to those investments, whether they are dealers, brokers, exchanges, or some analog that looks like one of those things, but is different because of the nature of crypto. And what rules should people be following as they transact in these assets and as they make these assets available to retail and other investors?
Very interesting. I think the follow-up question to that is, can you give us an example of what in the past historically? I don't want to get you in trouble. So what in the past has been considered a security in the digital world, and what is also now maybe under a commodities framework?
So, because it was such, I think in part because it was such a fact-based determination, what was or was not deemed a security depended very much on who was looking at the issue and looking at the asset at any given time. So, under the last administration, Chair Gensler had come out and said that effectively almost everything that he saw in the market looked like securities as far as crypto assets that were being offered, with the very important and significant exception of Bitcoin, which was always treated differently. SEC never really explained why it treated it differently, but it had been treated differently historically. There were open questions as to how the last administration was going to treat ETH on the Ethereum blockchain, whether that was going to be deemed a security or a commodity. A lot of it would come down to whether there was some person or identifiable entity or small group to whom others were looking to have expectations of efforts that would generate profits. And I think, though no one's ever come out and said this publicly from the SEC, because Satoshi Nakamoto pseudonymously developed Bitcoin and then basically disappeared and hasn't been seen, there aren't really active expectations that that person or somebody like him is going to be doing things to make Bitcoin more valuable, and therefore you sort of fail the expectations of efforts by a third party portion of the Howey test, and therefore Bitcoin should be treated differently. That's one theory. I'm sure there are others as to why that was not treated as security. As far as almost everything else, the SEC would often say, well, this is a newly created asset. Its success will depend primarily on the demand for that asset over time, since these are typically finite assets. There's only a certain number of them issued or minted at inception, or a finite new production schedule over time. And therefore, what's going to influence the price most is going to be demand. And are there individuals or small groups who are doing things to foment demand, to sustain demand, to make this a more attractive product over time that would make someone who buys it today richer a year from now because the asset value will have gone up as a result of those efforts? And that really depends on how you look at efforts and how you look at these projects and how much you value decentralization versus other attributes. It's very asset by asset and representation by representation specific.
Yeah, suddenly it's not so clear, right? Everyone looks at it and goes, "Oh, that's easy enough," and then suddenly, nah, it's not easy at all. Rob, I'm going to transition over to you. I know you're joining late, but that's okay. So the first question was, how does Project Crypto, the Clarity Act, and the CFTC's Crypto Sprint cycle or signal the next phase of U.S. digital oversight? So if you could take a real quick stab at that, and then maybe follow up with how might the initiatives now under those projects redefine which assets and activities fall under SEC versus CFTC. We got Dave's perspective from an SEC side. CFTC is obviously your wheelhouse. And if you could just tell us, what you see coming down the road, how it's going to define which agency handles that, and if there's going to be some overlap or some gray zones that emerge where both SEC and CFTC are looking at you.
Great. Thank you very much. Again, apologies for my tardiness, but hope I can make it worth the while. Yeah, the Crypto Sprint has had a couple of components. Number one, the agency, the CFTC, has called for comments in an information gathering stage of their new efforts to regulate. They have called for comments on perpetual futures. They have called for comments on any of the president's working group suggestions for the CFTC, and they have called for comments on the use of tokenized assets and stablecoin as margin. And that covers a wide variety of subjects in the CFTC's jurisdiction. Footnote point here, whether today a crypto asset is a security or a commodity, if it's a commodity, the CFTC has anti-fraud and anti-manipulation jurisdiction, but it doesn't have regulatory jurisdiction. So I always give the example that the CFTC regulates cattle futures, but it doesn't regulate cattle auctions. So that's why you see platforms like Coinbase and Crypto.com, their cash crypto platforms, have no obligation to register with the CFTC. And that's where the legislation in Congress is going, presumably, and it looks like it's getting here sooner than later. From the information gathering stage, the CFTC has also articulated a couple of principles that I think are important and hopefully helpful. Number one is that there's going to be coordination with the SEC and not a turf war. And at the beginning of the last administration, I was saying that reports of a turf war were greatly exaggerated. By the end of the administration, I was saying that they were no longer greatly exaggerated and they were very real. And the example that Dave gave about ETH is case in point. For a while, the SEC was saying that Bitcoin and possibly ETH were commodities and not securities. Then when ETH switched from proof of work to proof of stake, the SEC kind of went silent for a while. And then we found out from a lawsuit by a private party that was under investigation, they had received a Wells notice, and that's the only reason the investigation really became public, that the SEC was investigating them in connection with ETH-based transactions. And then the SEC backed down. They dropped the investigation and it went away. So it was unresolved, but sort of resolved. And let's see going forward with more cooperation. I think we'll get. I'll tell you, at the CFTC, behind the scenes, there were some hard phone calls. The agencies cooperate extensively. They're usually very good at it. But on this subject, like I said, there would be some contentious discussions about whose jurisdiction was what. The second principle that the CFTC has articulated, and the CFTC is currently one individual, the acting chairman, Caroline Pham, but and this is quite in line with the administration's priorities, is to bring digital assets onshore, whereas uncertainty and regulation by enforcement has kept a lot of activity overseas. And looping back to perpetual futures, that's a very important one. There really are not perpetual futures offered to U.S. persons, at least retail customers. There are a few exchanges that are offering perpetual style futures, which are similar, but they are long-dated futures contracts. And because there's uncertainty about whether they're to be classified as futures or swaps, U.S. person retail customers, their access to those depends in significant part on that classification. So the CFTC has talked about innovation exemptions to smooth the way for access in the U.S. and presumably they will take a look at perpetual contracts and the compliant way to offer those on U.S. exchanges, so you can bring that back onshore. And the last and most recent thing to come out is there was an announcement of an initiative to allow leveraged retail digital commodity transactions to trade on regulated futures exchanges. And it was just announced last week that the Binomial Exchange would be offering transactions in spot leveraged retail commodities. The leverage part is important because these are transactions that closely parallel futures transactions, which futures transactions take the form of a contract for future delivery of an underlying commodity at a specific date and time. And when leveraged spot contracts are transacted off exchange and there is no actual delivery of those commodities, they are sometimes called futures lookalikes because it's a very similar concept. So bringing these on exchange is interesting. We'll see what the demand turns out to be for them. But one possible advantage, there are advantages and disadvantages, but one possible advantage is that if there is no delivery date specified in a leveraged retail digital commodity transactions, then it is possible that the transactions will start to that they will closely resemble the perpetual futures that are available overseas, but are not currently available on U.S. exchanges. So that remains to be seen. As I said, there are some drawbacks to doing it that way rather than offering perpetuals, but it's the concept. I've been wondering what's driving this, given the similarity of futures and leveraged retail commodity transactions, and I wonder if it's that. So I'll be very interested to see what the demand is like for those.
Very interesting. This may sound odd, but I came away with three follow-ups on that. One, is there a place for crypto assets, tokens, that can fall outside of security or commodity? So that's to both of you. So is there some place they can fall that's not a commodity and not a security?
I mean, stable coins, I would think. What do you think, Rob?
Yeah, I love this question. It's something that I think about, like lying in bed awake at night. What is a commodity? And it's because the definition of commodity in the statute is pretty odd, but generally speaking, it includes anything that underlies a futures contract. So during the last administration, for most of it anyway, there were futures on Bitcoin, there were futures on ETH. And that left open the question, all right, well, what about everything else? Well, a couple of courts looked at it and they said that because Bitcoin and ETH are quote unquote virtual currency, which was kind of what they were being called at the time, because virtual currency underlies a futures contract, then all virtual currency is a commodity as well. And the CFTC used that theory to bring an enforcement action against Tether for its stablecoin activities. There was a settled fraud case against Tether in connection with its stablecoin. And of course, Congress rejected that approach, or at least, well, no, it rejected that approach when it passed the Genius Act, because those are outside the CFTC's jurisdiction. It specifically carves stablecoin out from the definition of commodity. But but there's now the question of everything else, right? So you have futures. There are more underlying digital assets now than just Bitcoin and ETH, but it still leaves open the question, what about everything else? Some things are securities, some things are commodities, and sometimes a thing is just a thing. So you have the digital assets legislation in Congress that is creating this new category of digital commodity that'll presumptively be under the CFTC's jurisdiction, moving it out from the does it have a futures contract test. And I'm interested in a couple of aspects about how that plays out. But you said you had three, and we only have an hour. So,
Dave, 30 seconds, take a shot at that. Is there some place that crypto or some type of token could fall outside of CFTC and SEC regulation?
I mean, I think it's more the question of how you know which regulator you're reporting to, because the SEC, similar to the CFTC and their kind of Crypto Sprint, the SEC has Crypto Task Force and has spent a lot of time gathering new information, putting out additional guidance about assets that previously had been sometimes the subject of enforcement actions that are now deemed not to be within the securities jurisdiction unless specific facts and circumstances are very unusual are also present. Thinking about meme coins, thinking about some proof of work and proof of stake mining, including delegated proof of stake mining, all have been subject to guidance saying those we don't think are core to SEC jurisdiction. And Chair Atkins recently gave a speech where he said most assets don't seem to be part of a live investment contract from his view. However, the SEC retains fraud jurisdiction. The only way the SEC retains fraud jurisdiction is if those assets for which it is pursuing a claim of fraud are securities. So the underlying still has to be a security, which leaves open the possibility how he lives. These assets could be offered and sold in a way that creates sufficient expectations of efforts that it becomes a security. And so now you're still in this really fact-based world where you have to look at the offerings and the expectations and the reasonableness of that to determine whether an asset is a security or commodity. Hopefully legislation or rulemaking will create some brighter lines, but right now we're still in a fact-specific world, admittedly, though, one where the facts tend to cut away from securities and towards commodity definitions.
Wow, that's very interesting. I had two more, and one is a statement less than a question. And I've done a lot of these Merkle meets. I've been over in London. I've been over to other jurisdictions and spoken with barristers, attorneys, and legal people in different places. And I can tell you the one thing that almost always comes up. It's the Genius Act in the United States, and the Genius Act has brought the U.S. kind of to the forefront of where innovation can happen. Now, I don't know if that was intentional. It probably was, or it's just the way things played out. But I can tell you the United States looks like a much better place to do business than, say, the EU or the UK right now. So I guess that's good for the United States, but it also is going to bring a lot of work to CFTC and the SEC as we move forward. So that's the statement side. The second side is for Rob. Could you just define for the audience what a perpetual future is?
Yeah, thanks. That's important. So it is a contract that closely resembles a traditional futures contract, but traditionally a futures contract has a delivery date. It's not typical to actually take delivery of the underlying commodity, but it has a date where there is a settlement. You settle by offset, and if you want to continue to have a position in that futures, you have to roll it into the next month. Sometimes it doesn't happen cleanly. There are costs associated with it. The prices may not match perfectly. The timing may not match perfectly. Perpetual futures do not have a settlement date or delivery date. Price convergence, typically what happens is they have settlement multiple times per day, where they have a funding rate based on the cash price of the particular digital asset, and they settle the price of the perpetual future to the cash price that they're referencing. And this has become hugely popular overseas. One study found that price discovery in that fashion in Bitcoin happens more in the perpetuals markets for Bitcoins than it does in the cash price for Bitcoins. So the price tends to gravitate towards the perpetual price, the underlying does, which is very interesting. They've become hugely deep in liquid markets overseas that don't exist yet in the United States. As I said, they're perpetual style futures here, and they're gaining traction, but the activity has, at least until now, been entirely offshore.
And Rob, the attraction of perpetual futures is access to leverage and margin, or what is it that makes that a more attractive than spot product in those markets?
Well, overseas, the leverage is very, very high. Leverage is always going to be an attractive option because obviously you can use your capital in some other way. That's always the attraction of a derivative over taking a cash position in the markets. Overseas, you could see 50 times, 100 times leverage. I don't know if we're going to see that in the U.S., but it'll certainly be a more cost-efficient way of getting exposure to a digital asset than to buy the full quantity of the cash commodity.
Yeah, that's quite interesting. I think the area of crypto quant data. So we used to all be in a blockchain analytics, just doing tracing, but I think blockchain analytics really is making a transition to this new style of what's in trading, and this type of trading is not like on the stock market. There's so many metrics you can get on chain nowadays, and basically surveillance of the market just to average it's available to the average person is huge. So the world is changing the way it does. We'll call it DeFi because that's what it is, right? Decentralized finance. Moving forward. Um, so the next question here is really, we kind of been down this road already, but how do you see enforcement actions today versus just about a year ago? Obviously, we probably have fewer, but I'm thinking the ones that are maybe going on today are a little more substantial, a little less built around, like the whole choke point and some other issues that were going on. But I think probably more substantial. And do you think this is going to continue? Do you think where we are today is going to continue to be the norm in the United States? We'll take out the day first. That's kind of a big one. I mean, everything's a big question here. It's a lot to unwrap.
Yeah, no, it is. These are hard questions to answer, and probably won't know until more time has passed. But certainly, enforcement is 180 degrees different today. The SEC dismissed a number of cases that were actively being litigated in U.S. district courts, and one that was considered up for appeal to the Second Circuit. And in so doing, basically, I think stepped away from the theories of the last administration as to what supports an appropriate enforcement action. And so certainly a lot of those cases involved claims of registration violations. So some entity was either issuing like the offered sale of a security or was intermediating those transactions as a broker, a dealer, or an exchange. The SEC had taken a position that requires you to register as either a broker, a dealer, or register the offer and sale of the security. And the new administration has basically walked away from all of those cases, giving the implication that in most cases they are not as worried about the registration requirements that go with those rules. The statement that's going to retain fraud authority, I think, is likely going to be played out. I expect we'll probably see more pyramid scheme type fraud cases. We're going to see other rug pull type fraud cases. There's been a big focus publicly from the SEC on foreign issuers. And so I wouldn't be surprised if there's some foreign issuer overlap with crypto where there's a fraudulent scheme the SEC seeks to pursue through an enforcement action. But I think overall, the pace of enforcement in that space is going to be much, much lower from the SEC and probably lower, but maybe not as dramatically lower for the CFTC, whose jurisdiction, if anything, may be increasing as a result of this sort of shift in administrations.
Yeah, interesting. I was asked not too long ago, what do I see coming out of this new enforcement regime, which is a lot less active than it was previously? And my response was that I think right now we have an area that's kind of building like the ICO days, kind of like we're going to see a lot of innovation. We're going to see a lot of people running. We're going to see a lot of things coming out, a lot of new technology. But then, 28, 29, and 30, when these years approach us, we might see a lot of follow-up investigations of things that are happening today versus other things moving forward. So
it's a really important point. Like, I think a lot of folks who are in the space are trying to figure out how they comply while the regulations remain a little bit murky. And I think some smaller percentage of people are taking the lack of oversight as an opportunity to do crime or otherwise just kind of bend corners. It's unfortunate. It happens in every market. Typically, as regulatory oversight goes down, some of that activity goes up. And while this administration is very friendly towards crypto, so far most of that is done by guidance and vibes, but not by longstanding laws or rules that will extend from administration to administration. And so conduct that might seem acceptable today may be viewed differently in a new administration. And administrations typically last 4 years. Statutes of limitations often run 5 to 10. And so it's just challenging for businesses to figure out how to try and make sure that what they're doing today is still going to be viewed as acceptable by a future unknown administration.
Yeah, if I was advising a client, I would tell them to stick with the old rules And enjoy the climate we're in today, but stick with the old rules because we don't know what's coming down. We don't know what the next administration, what's going to bring, or it may stay the same, it may be different. We don't know, but that's the point. Rob, I think something for our audience, which might be hugely beneficial for the audience, is can you describe, not so much in detail, but if a new person's out there going, I just think I want to open exchange, I got a couple $100 million, how do I register in the United States? What do I do to be legal in the U.S. to make this happen?
Well, if you are running a pure cash commodity exchange, digital asset exchange, you have no obligation to register with any federal agency unless you are offering something that even today the SEC would be considering a security. Then you have to register as a national securities exchange. And at least I gather from the last administration, when they were telling people they were required to do that, that there was actually no way to do that, and so you were out of luck. But today, as I said, exchanges like Crypto.com, like Coinbase, they have no registration requirements whatsoever. Now, if you're going to offer something on leverage, then you have to become a designated contract market or a swap execution facility. But today you have there may be state licensure requirements that you have to satisfy, which I think is something that will go away when Congress ultimately passes the Clarity Act or a version of it. But right now, there is nothing. And Dave answered the question about enforcement actions, so I'll go back to that, and I can answer it in seconds about the CFTC's enforcement actions. There are none right now, so that's an easy answer. But it's so important, the point about the statute of limitations. We are always telling clients across a range of issues that have nothing to do with digital assets, when they're making a judgment call, but bear in mind that there are 3 years left in this administration, and the statutes of limitation, as they've said, are longer than that. So everybody's going to have to continue to be careful about their conduct today, as you said, Robert.
And I would add to Rob's answer, and he's completely right about financial regulators, prudential financial regulators. The one exception, I think, for exchanges is that they often do have to register with FinCEN as money services businesses, subject to the BSA, and then that also often requires them to get 48 to 51 state money transmitter licenses, which, for my friends who work compliance at exchanges, is kind of the bane of everyone's existence. And the hope is, if Congress does something standard at the federal level, that can allow institutions to just satisfy one regulator about their money transmitter practices rather than having to maintain 50 different licenses, which is a lot of duplicative and unnecessary work.
Right. Is there any provision in the Genius Act that allows for, and you just talked about the MTL's licenses in the 50 states. Is there anything that preempts those licenses federally in the Genius Act, or is that just strictly going to be a Clarity Act issue?
I think that this is outside my area of expertise, so Rob or someone else, please check me. But I think that if you're a federally chartered issuer of stablecoins under the Genius Act, then you're subject to FinCEN's oversight and the feds, and either OCC or FDIC or National Credit Union Administrator, whatever it may be. But you are not also subject to state level regulations at that point. You preempt out of it. If you're a state issued or state chartered issuer, which is provided for under the Genius Act up to $10 billion, I think it's $10 billion, then you might still be subject to, I think, state money transmitter laws, and that may have an impact on where you decide to charter to try and minimize how many different masters you have to report to on issues of money transmission.
Right. Now, I'm assuming that OCC charter is going to be a much more difficult charter to get than a state charter. That's just a thought in my head. I don't know if it's true or not, but it seems like it would be.
I expect it will be. The Genius Act is really interesting in that regard, in that it allows you to choose a path. And then once you exceed whatever that cap is, as I said, I think it's 10 billion, but it might be a different number. You then have a year to either acquire an OCC or other federal charter, or you have to convince a 3-person committee that the state regulator you're currently responsible to has a level of oversight and controls comparable to that offered by federal regulators. And so there is a path where you could stay a state issuer, but it's a narrow path that's not yet been fully defined or built out with rules.
Yeah, so it kind of feels like, well, it is based on how much business you intend to do and what your valuation is. So, right, $10 billion is fairly substantial. I mean, it is a substantial amount of money, but I think in the DeFi world, $10 billion is not that great of a sum versus a federally charger, which is over that. So, yeah, that's very interesting the way they set that up, and it'd be good if we saw some kind of clarity around the 50 state MTL license. That's like the biggest thing that keeps a lot of people out of it. They look at the MSB registration with FinCEN and be like, oh, that takes about 2 minutes. But the MTL takes a lot of time and a lot of money. You know, accountants and attorneys, no disrespect, gentlemen. You know how that saying goes, right? But you're going to need a lot of both of them. So if you want MTLs, so yeah. So, gentlemen, moving on. I did have one other follow-up question, which I'll leave to either one of you. We have the regulated, DeFi. If you want to be in an exchange, you want to do DeFi. It's more like centralized finance if you're doing it through an exchange. But if you want to trade in all these different crypto products, is over here. But what about these decentralized contracts that are just out there? I mean, you open up, you look at either scan and say, show me contracts that are DeFi related, and you're going to see a ton of them. What's the enforcement side over there look like? Is there going to be enforcement over there, and how do they even go about that? And I think one other question that's really important there is, what's the rules around a decentralized contract? Is somebody back there responsible for it?
Well, under the last administration, it was either impossible or close to impossible to offer DeFi crypto assets, which I think always involve a degree of leverage, because the CFTC considered them, and reasonably so, to be swaps. And they were off exchange swaps, meaning that retail customers cannot access them. Going forward, it's still very, very unclear. The CFTC is not bringing enforcement actions about them. And by the way, to go back to the last administration, they were holding people accountable because they operated the website, or people who exercised their voting rights under tokens that they had in DeFi arrangements. They even served process on a DeFi system by posting the notice in a chat box that was available on the website, because who do you serve, right? And then nobody showed up to defend the case because they all took the position that that's not me. We're decentralized. I'm just a user of this system. Going forward, it's very unclear where the legislation is going to go on this point. In fact, in the Senate Agriculture draft, it's a discussion draft right now, they put a insert here note or something along those lines in the DeFi section. They found the Clarity Act section on it far too permissive, and it's, if anything is going to take a great deal of hashing out between the chambers, it's likely to be that, because it's a big unknown right now. From a regulatory standpoint, it could be a place where the CFTC wants to offer one of those innovation exemptions that I mentioned just now, because they don't want DeFi snuffed out because of how the current law looks at those arrangements.
Interesting to say that. Yeah, we don't want to see DeFi snuffed out. Well, I'm sure there's somebody. I'm sure there's a market somewhere in the United States that wants to see DeFi gone. Well, we'll leave that for another day.
I'm always interested in that. I mean, somebody's making money at this, right? People are going to a lot of efforts to get the right legislation, the right rules in place. Yeah, certainly there are people in government who think that this should not be available to retail customers, because, listen, transactions on leverage with no central counterparty or anything like that, you're taking on risk. The level is the question is, how much risk are we willing see, I'm on my cell phone now. Somebody is calling. I'll finish up this answer, but it's a policy question. How much risk do you want to leave to market participants to accept knowingly, and take care of it with disclosures and the like, and or how much do you want to take out of market participants' hands and make a decision at the government level?
Yeah, I think that goes along with a lot of times I hear people say, well, just be a big boys and girls, and that risk is risk. You accept it, you accept it. But I agree. There's got to be a place for for people to snuff out unreasonable risk. The definition of that is who knows. But
yes,
David, I'm sorry, I kept cutting you off. My apologies.
No problem at all. Yeah, no, I think the SEC viewed it very, very similarly in that DeFi can pose great efficiencies opportunities, composability opportunities, and just a change in the way that transactions clear and settle, which could be really helpful for shareholders and customers. But they also pose some significant market integrity and market oversight risks, some big AML KYC challenges, and some real information disparity challenges, which have all been areas that the SEC is traditionally policed through centralized actors who need a license from the SEC to participate in their portion of the financial system. DeFi exists without that imprimatur from any regulator and continues to function at scale without a regulator's approval, and the ability of a regulator to hold any individual or small group accountable or to identify the right person to be responsible for performing a certain level of compliance function, very challenging. I think the last administration, they looked at trying to hold front ends responsible when often the primary function they were performing was as an entry point that would translate human language into computer code to execute a particular transaction. It seems different in some important ways than traditional security brokering, but at the same time, if you don't hold the front end accountable and all you're dealing with are smart contracts that exist on a blockchain, if there's a problem, who's responsible for it? How do you both kind of change bad behavior while you see it happening and put people right if they suffer as a result of that behavior?
Yeah, who do you hold responsible? I mean, I guess if you go down that line of we're trying to hold the back end, whoever created the code or launched it, or because somebody physically hit the enter button at some point in time and launched it. If we go down the code, I mean, does that mean that people who are staking Ethereum are now somehow involved in Ethereum? Does that mean I mean, I just think there's so many places that can end up being, if we're not really careful about what we and I say we collectively as the United States, about what we consider to be the actor behind some of these things. So
now you say that, Robert, that there is an actor, but now you plug AI into the equation, and maybe there is truly nobody who made the decision to commit wrongdoing. What if the AI bot figures out that the best way to make money is by some kind of market manipulation? I don't know if you can program the bot not to do that, and if it does, and if it's disruptive, I mean, you can imagine something that is disruptive far beyond anything that a programmer could have imagined, and yet have nobody really to hold accountable for it. So it's a big question. I don't know I don't know what the answer is, and I don't know where it goes. So we got human beings, and we've got robots, and especially when the machines become self-aware, then that's when we are in really big trouble. I've seen all the Terminator movies at this point.
Well, we are. I don't know how close we are in reality, but it feels like we're close. And I use AI every day, and I'm sure most people do. Some of the things that you're able to create these days is just incredible. Number one, especially for a novice like me. And you're absolutely right. You really just don't know. At the end of the day, I mean, is Sam Altman now somehow responsible because of AI that launched all these contracts? No, I don't mean that exactly. But is that kind of how it goes? The person to create the AI is now responsible for launching a contract that is now responsible to one of these two agencies for a security or a commodity. I mean, yeah, who knows where this ends? It's like a big round robin, and technology moves very, very fast. So it's going to be very interesting.
So
I will point out that if you want to know what the law is, AI right now, or at least the big commercial ones, it's almost always lying about what the law is. It makes it up far more than even these reports about, hallucinated cases cited by judges and litigants. I use it every day, but it's like having a bad associate that you kind of get a little bit of a piece of a thread to pull on, but certainly don't rely on it.
Yeah, I think practical law or Westlaw or something like that is probably where you need to stick around for a while. Don't be asking Perplexity or Chat GPT what the rules are or the law is. You're probably
Yeah.
not. It's probably not the opinion you're looking for out there. So yeah, gentlemen, it is 10 till. We promised a Q&A session. So if there's a question with the audience, please let us know. I don't see any that popped up. So yeah, no questions yet. So if you do have a question, throw it in there. If not, I'm going to give each of you a few minutes to close up and give us thoughts on the future and how we make the world better or how we make this whole thing better in general. David?
Yep, happy to jump in. I mean, I will start by saying this is all extremely challenging. When I was working for a commissioner, I spent a lot of time trying to think about regulatory solutions that could work for the SEC that would both allow for the kind of innovation that I think we want to promote in this country while also protecting the $110 trillion of other capital market activity that the SEC oversees that is very high functioning under the current rules. Like, how do you create a new different compliance system for a nascent market without disrupting what currently exists is very challenging. The rulemaking process and the legislative process typically takes more than a year to absorb the new information you need to understand even what problems you're trying to solve and come to some consensus about what those solutions look like. But the pace of development in crypto and other innovative technologies is typically much faster. So they ship faster than legislators write, and that can create a lot of challenges with coming up with solutions that are both accurate and timely. And I think the issue of DeFi is going to continue to bedevil us. Like the central philosophy of crypto was peer-to-peer, and so being able to self-custody remains central to whatever legislation should look like. But the more you allow people to self-custody, the less you empower regulators to bring order to markets that can get disordered if left to their own devices.
Yeah, interesting. You brought up self-custody. That's a big deal over in the EU right now. It's what they're going to do with self-custody. I have a dollar in my wallet, and that's self-custody of my dollar. So why shouldn't I be able to self-custody a Bitcoin? Just my thought on that. But Rob, what's your closing thoughts here?
No, it's an interesting point about self-custody, the Clarity Act, and I'm not sure if it appears in so many words in the Senate Ag version, but the Clarity Act says you have a right as an American to self-custody digital assets, which I think is an extraordinary thing to see in a piece of legislation. Bills in Congress don't typically articulate fundamental rights like that, let alone in something that is so in the grand scheme of things, new. So I found that very, very interesting. What lies ahead? Let's assume that Congress in the next few months passes legislation, the president signs it, which he certainly will. The rulemaking kicks into high gear. Both versions of the legislation delegate a lot to both the CFTC and SEC, and in many places they expect the CFTC and SEC to engage in joint rulemaking. It's going to take years in order to nail some of this down. Dodd-Frank was the most comparable experience. This is not going to be quite so heavy an undertaking, but it took the CFTC a few years to get through that. It took the SEC many years to get through that, and I was in the middle of some of that joint rulemaking. That was very, very challenging, right? I mean, it's something that may not rise to the level of a turf war, but just extended staff discussions. So this is going to take a long time. I think there's going to be a lot of feedback from the industry and from the public when they put draft rules out for notice and comment. It's going to take the agencies a very long time to sift through all the perspectives. Staff is down in both agencies. That's very unhelpful. The CFTC, which is not a widely loathed agency, and not an agency that is that the current administration is hostile to, but a lot of the most experienced and knowledgeable people have either been asked to leave or have taken incentives to retire. And it's not just enforcement activity that agencies engage in that that private actors may want to keep contained. It's things like licensure and product review.
Yeah.
That if agency staff and experienced agency staff are just not there, it's going to take forever. So we're looking at a long road, and it's probably going to be a period of years before everything is finalized. But the good news is there will be more clarity, at least on the front end. Some of the stuff will kick in before regulations are issued, and the statute has been aptly, the working title is a good one, and it's what everybody's looking for. So I think no matter what you think about digital assets, whether you're a skeptic or somebody who is really invested in it, clarity is a good thing, and I think that's going to be very helpful to development and safe markets going forward.
Interesting, the word clarity in a congressional act that's probably intentionally ambiguous so that it can be set out for rulemaking, right?
Yeah.
Yeah. Thank you, gentlemen. We don't have any questions. This was a powerful panel this morning. You guys tore it up, and I think you've answered a lot of massive questions that people have out there in general, because crypto is still kind of this thing in the world where people are a little bit, they look at it kind of like this mystical thing over there that they don't know how to get into. And certainly when you start talking about moving into the space and being an entrepreneur in the space and bringing some innovation, you certainly wonder how regulation is going to affect you. And you guys answered a lot of good questions this morning. So I certainly appreciate it. And thank you very much for being on Merkle Meets today. I think we'll end it here. We're about 4 minutes early, but that's okay. Gentlemen, thank you very much. Have a great day. And your names and everything appear here. We're going to have this put out on YouTube in about 24 hours. You'll get to see the link first and go over it real quick. But be on YouTube. People will be able to watch it there if they missed it today. And we really appreciate your thoughts and comments around this. Ladies and gentlemen, Rob Schwartz and David Hirsch, appreciate you very much. And thank you. Have a great day.
Thank you, Robert. You tore it up too.
Thank you, gentlemen. Have a good day.
Enjoy it. Bye.